Thank you all once again for joining us. It's now 7:05 p.m. We are going to start our training. My name is Elizabeth Wanja. I'm the Brand and Communications Officer at Octagon Africa. So before I introduce the speaker of the day, I know that some of you who are not members of Octagon here. So I'll just give a brief introduction about who we are and what we do. So basically, Octagon Africa was founded in 2007, and we are a financial services limited that deals in 4 major strategic sectors, which include training, which is what we are doing here. We are pension experts. We deal with insurance, brokerage, and actuarial services. Basically, our partner is Alexander Forbes, who we partnered with them because of their global and international research and experience. We have branches in Kenya, Uganda, and Zambia. So why are we doing annuities today? Is because many of you have been asking questions about annuities. You want to know how this works. And our speaker of the day today, who is George Ogada, he's a business development executive over here at Octagon Africa, and he is also a pension expert. So he will explain to you what an annuity is, how it works, and how you can get an annuity when you retire, whether it's a viable option, whether it's not, you will decide today. So I would like to know that I'd like you to know that we are recording this session. We usually record them so we can upload them to our YouTube page, which is at Octagon Africa on YouTube. So you can go over there, subscribe, and watch other pension clinics that we have done before. So what's going to happen is that he's going to do the presentation, and once he's done, you can raise your hand if you have a question. I will be able to unmute you. And even in the midst of the conversation, you can always type down your questions in the chat section, and he will be able to address them all once he does, once he is done with the training. So without further ado and taking much of your time, allow me to introduce the speaker of the day, George Ogada. George, the floor is yours. Thank you.
Thank you very much, Elizabeth. Thank you, members, and all the guests that have taken the opportunity to join this training. Before I start, allow me to confirm if you guys can able to see my screen.
Yes, George, we can see it. Just maximize it.
Thank you.
Yeah, you can see
Can
it.
you confirm whether you can hear me?
Yes, we can.
Thank you very much, ladies and gentlemen. My name is George Ogada, as my colleague Elizabeth has stated. Today, I'm going to make a very interactive session so that you can able to understand why everybody is entitled or one is in a position to purchase an annuity. So before I just go to annuity, let us now understand a pension structure. And first of all, a pension structure composed of a board of trustees. We have a custodian, or the fund manager. We have administrators, we have auditors, and actuaries. So ideally, when you look at the structure, you can able to understand how pension is being managed and the way pension is well protected. So the work of a custodian is to ensure that your money is safe. When you invest in a scheme, your money is safe. Their work is to safeguard your funds. And then the work of administrator is just to keep record. Ideally, like us as Octagon Pension, our work is just to ensure that your record is well kept. We keep record and ensure that anytime you want to retrieve your statements, your records, that is well managed by administrators. Then we have the fund managers. Ideally, after you members of the scheme are already put the money in the custodian, what happens is the money is invested, and that's how you can able to get the returns at every year. And then we have also auditors. Auditors, their work is to check on the books to ensure that every record is well kept, and to ensure that all the records and financial management and all the data is well protected. That is the work of auditors. And what happened that auditors, we outsource the auditors and also the actuaries. So how can you access your pension? Ideally, probably I'm talking to member of the members here who are about to retire, or the members, some are very young, and they're asking themselves, yes, I'm reaching a position where I have to access my pension, or where, at what juncture, at what point am I entitled to leave or access my pension benefits. So one, you can able to exit. Once you exit or resign or get dismissed, you are able to access 50% of the employee and 50% of the employer. Secondly, when you retire, whereby there's an early retirement and normal retirement. Normally, the early retirement is the age of 50. So when you attain the age of 50, ladies and gentlemen, this is the time that you are allowed to take your money either in lump sum or in pension or in annuity. So, and there's also a normal retirement. The government recommend that each and every member who is in a formal employment can retire a normal retirement of 60 years. We also have exception of people who are above 60 or 65 or above. Those are either people are disabled. Sometimes the government has given them an extra 5 years. That is the age of 65. However, also the people who are in a professional industry, like the doctors and lecturers, their retirement age are up to 75 years. So in essence, the early retirement is 50 years old. The normal retirement is 60 years old. There's also a class of people who retired 65, and the professional retiring at a maximum of 75 years, i.e. the lecturers. So another area where you can able to access your pension is when you are ill health, you are either sick or you have a disability. So this is upon confirmation by a doctor. The payable is subject to approval or submission by medical reports on a basis of mental or physical disability. At this juncture, you are allowed to access your pension when you are able to confirm that you have a disability. The fourth option is immigration. So you can access your full benefit subject to location or proof of citizen and approval by trustee and regulator. This is when you are leaving immigration, meaning that this is a time that you have decided to move out of the country, or probably you got a visa and you're traveling abroad, and you already confirmed that you already access the citizenship of the company, the country that you are migrating to. At this point, the laws allow you to take all your benefit because you are no longer being a Kenyan citizen. So you are free to take your money when you are leaving out of the country upon a confirmation by the regulator. Lastly, you can also access your pension when you transfer your benefits. So when you're moving from employer A or a company A to a company B, you can also access your pension. You can go and seek a transfer form and request the member, the trustee, so that they can able to transfer your pension to another pension company. Ideally, at this point, you cannot access your pension, but you can only access a transfer money, which is subjected to a tax. Mode of accessing an income drawdown or replacement. So there are two ways of accessing your fund, ladies and gentlemen. You can access your pension through a pension or income drawdown. So when you are talk of pension, this is a lifetime annuity where you can able to, the laws allows you to take your income or your pension through lifetime annuity. Another option is through income drawdown, where you can also take your money when you reach the age of retirement through income drawdown. The industry, upon a research by RBA, we have a research, if you look at the table, if you can able to see the table, we look at the life of a retiree, and in most cases you realize that few people retire comfortably, and the people who retire and those who are having pension, only 6% are financially independent. And you look at the table again, you look at 16%, most of the people depend on pension, and 45% depend on relatives, and 31% are still working, meaning that upon reaching the age of retirement, ladies and gentlemen, it's a challenging and a time that you realize that as much as people retire, go home, only a fraction are on pension. Only 16% are on pension, meaning the majority of people are not on pension. The government is working hard so that this bracket of 16% can be able to be expanded. So at the end of the day, you can have a big number of people that rely on pension so that we reduce the dependence. Because look here, people are like African culture where we come from, you realize many people are educating their children in the event that the children grow up, they can able to rely on their children to send them money so that this money that the children send them can be on pension. However, upon the children reaching the adult age, sometimes they cannot even afford their basic need. So if a parent has been relying on a parents have been relying on a child, that in the event that a child get a job, then they can able to support the parent, then probably it cannot be true, because however, even the children themselves may not support themselves at the age that they reach the age of adulthood. So any person who depends on a child probably may not able to enjoy his life or her life, because your child is not a pension. So many people also look at the fraction. The government also, these people also take lump sum. So if the people take lump sum and start business, you realize 21% collapse businesses. They do not perform very well. And you look at some people are running business, 48% are not profitable. And then you look at the operating profitability and only 31%. So meaning that even if you take the money and go and start business, so most chances is that you can fall in the category of 21% that are going to collapse. Or you can fall in the category of 85% who are not making profit. So that means that only 31% of the people who have retired and gone home to start a business, only 31% are making profit. So the question is, where do you belong? Because ideally, you should be starting a pension at the age of 60, and you're enjoying the monthly income every month without lapse. However, if you choose to take the lump sum and you don't put the lump sum spread on pension, then ideally, the chances of you collapsing the business that you're going to start, or you are going to run a business which is going to make profit, is 48%. So if you look at 48% and 21%, you realize most likely you are going to have around maybe 69% of the business that are not going to lap to perform well. So we're looking at this 68%. These are the members of a public who are retiring. They have lump sum. They have given money to go home and spend. However, 68% will not make it. So that's why companies that are running pension advise member of the staff or member of the team that are retiring that kindly choose the option that can able to be sustainable. And the most sustainable way is to able to go the annuity way. Annuity way where you can able to get your income so that you don't fall the victim, as the graph shows us. You look at the income replacement ratio. Ladies and gentlemen, income replacement ratio is a person gross pension after retirement divided by the his or her gross income before retirement. So meaning that if you want to know your income replacement rate, that's IRR, then you must divide your current pension minus 60 then you divide the last salary minus 100. So you can know which fraction you are in. If you are living with, if your pension which you are going home with is able to be sustainable now. So you can take a pen and try to calculate this fraction and see if you are within the international global standard or society recommended for at least an IRR for 60% of a member to achieve a reliable level of comfort requirement. So when you are 60%, that means your level of comfort is okay. At that time, you can enjoy your pension. But when your pension rate is below 60%, then you're not likely to enjoy your pension because your income replacement ratio is low. So we recommend that you do your calculation so that you know what is your current pension now. What is your last pay salary? If you do that and divide, you can able to know where you fall and where you belong. So we wanted just to talk briefly, ladies and gentlemen, about the annuity so that you can able to understand why do we recommend you take an annuity. First of all, annuity is just a specified income payable at a stated interval for a fixed period. And this fixed period can be either, you can be paid monthly, you can be paid maybe periodically, maybe after 6 months, or you can say, I want my pension to be paid annually. So it is upon you as an applicant who can choose how much interval do you want? Do you want to be an interval of within a month or within per year or quarterly? So it's upon you to decide how you want your annuity to be paid. Annuity can be in constant or non-escalation or increasing escalation. So escalation means we are going to subject your annuity upon your request that you want. You can either decide that I want my annuity to be escalated, or I want my annuity not to be escalated. Meaning that, remember, when you're giving you an annuity, we also factor in the exploration of the country. So once you were able to explain and understand how the market is performing, with that you can able to escalate based on the market trend. So annuity also is increased by fixed percentage annually as appropriate or to offset the effect of inflation. So inflation also affects the annuity. So once you're applying for annuity, we can able to advise you on annual increment or fixed annual increment so that you can able to restructure your pension. You also have a guaranteed pension. A guaranteed pension payment assured on a minimum period regardless of the longevity. So meaning that once we give you an annuity which is within a fixed period of time, meaning that we are not able to inflate the pension that you're paid in a monthly basis. So once an annuity is in payment, it cannot be rescinded, purchase, or decision, or opt out, meaning that you can't opt out of annuity. For example, if you take annuity of 10 million, there's no way you can able to opt out saying I wanted my cash money or I wanted to restructure it again. You cannot restructure the annuity. The lump sum that you already submitted or confirmed that this is the amount that I'm committing for annuity is subjected to a periodical payment for an interval or either monthly or yearly. So you cannot restructure it again upon purchasing an annuity. So annuity is fixed and is payable on a monthly basis as per the client request, or yearly or quarterly. The payment usually continue after the first death, but limited to guarantee. So what happens is when you have an annuity payable, and God forbid you die, for lack of a better word, then your beneficiaries that you mentioned in the application or the proposal form will able to enjoy or able to still use the annuity till the given period. Normally, we have 10 years guarantee, 15 years guarantee, and 20 years guarantee. So you can able to state that I want my annuity to be spread within 20 years or 10 years upon my death, so the beneficiary can able to still proceed to earn the annuity. Annuity can be single life, joint life, last survivor, deferred annuity. Yeah, actually, you can decide to have a single life annuity where it's you and you're the only person who enjoy the annuity. Joint life or last survivor means that there's a third party or a second party that you already incorporated in a proposal form that also have to be part and parcel of the annuity payment. Or you can also defer the annuity to another third party that in eventuality that you're not existing, the third party that you've already deferred is the one is going to withdraw your annuity. If both lives die before the expiry or balance, if both lives die, for example, if you put a joint life and then both of them die, the balance of annuity installment will be payable to the nominated beneficiary. So meaning that if both of them die, there will be the balance that is paid, the balance that remains will be payable to the nominated beneficiary. Ladies and gentlemen, we can have a look of the first illustration of one age 60 years who has been contributing and they have purchased an annuity of 1 million. So if you look at this category of people, we have male and female. So for course, this person in the scheme has generated or contributed in a period of time or this period of time 1 million, then his annuity per annum is 124,200. So this is a male. So look at the female part. The female will earn 118,320. This is for female. And when you look at both female and male, you realize that male are getting more annuity compared to female. And even you look at the monthly annuity, where a man is getting 10,350 and a female is getting 9,860, is less than what the female get is less than what men get. Simply because this is done by actual science, and they've really proved that there's a reason why they put that, not by coincidence, but they say women live longer, so more than men. So probably they know when men are not living longer, then the women will live more and enjoy more money than us. So likely they're likely paying less, but it's a bit biased or gender or gender sensitive. But this is the actual reality on the ground, that female will live long and they're likely to have less than men. When we look at this illustration 2 on the annuity, where one has purchased an annuity of Kenya shillings 1,666,666.67. So, and this is why I was talking about the escalation and the guaranteed. So there's two providers here offering annuity. We have a service provider A and a service provider B. So we assume this is a single life annuity. And we look at 0% escalation, which is with no guaranteed years. That is, no guarantee is like zero guaranteed. So this member is entitled to have 17,976 per month. For 5 years, if you put a guaranteed of 5 years, is 17,716. That is for 5 years. For 10 years, is 17,061. So when you look at the category service provider A on a 0% escalation, then you realize that this person is going to have 17,976 for a zero guaranteed. But it is slightly lower when you do 5 years guarantee, and again lower when you do 10 years guarantee. And what is the logic here? Because when you do zero guarantee, that means upon your demise, zero guarantee, the first column on 0% escalation, ladies and gentlemen, I hope you are together. If you do zero guaranteed, meaning that this 17,976 is slightly higher because you, upon your demise, and you didn't, upon your demise, then the beneficiary will not proceed on to earn your annuity. Upon your demise, at the age of 5 years guaranteed, then your beneficiary will be able to earn your, for the next 5 years, your beneficiary will be able to still earn the annuity in the next 5 years. On the column 3, provider A, on the same figure, you realize that you'll have 17,061. So meaning that upon your demise, and you choose 10 years guarantee, then you will still have to, the beneficiary will proceed on earning the annuity for the next 10 years. Contrary to the person who considered non-guarantee, who considered the first column, which is zero guarantee. So ideally, when you're applying for an annuity, always consider the maximum number of years guaranteed, meaning that upon your demise, then the next of kin or the nominated beneficiaries will still proceed to a minimum of 5 years to 20 years. However, if you choose zero guarantee, meaning that they will not enjoy, so meaning that the annuity ceases to perform, and you cannot claim back because you choose zero guarantee. So when applying for an annuity, always be advised to consider the maximum number of years. If you look at, section B on the same service provider, you find that we have outsourced another quote from another service provider B. The service provider B is offering 16,440. Yet the service provider A is offering 17,961. Meaning this service B is not giving you a value for your money. You are going less with the money. And remember, 1,000 shillings is a lot for somebody who's going for retirement. So we advise you not to take less. Always negotiate for the maximum amount of money that you can able to go home with. Why would a service provider B give you 16, yet a service provider A giving you 17? So the most important thing, always negotiate for the best and the best take home for annuity when you are going home. Don't look for one quotation and make a decision. Don't choose one provider. Always ensure that you choose different providers so that you can able to know how much they are offering. And then again, look at the stability of the institution so that when you go home, you know your money will be paid correct. The process of annuity purchase is so simple. For those who are retiring or those who are about to retire, it's so simple. Annuitant just purchase, you agree to pay annuity through installment, through a life officer, and then the money is just paid direct to your ATM or to your bank. So the process of getting an annuity is once you are ready and you reach the age of retirement, or you feel like you want a retirement package, which probably choose annuity, kindly liaise with the service providers. Kindly go to maybe Octagon, where we present, ask them to source for you quotation from different underwriters. So once you have those quotation, then you can have a wise choice or a wise decision for you to be able to go home with a good package for annuity. So ladies and gentlemen, I don't have much to speak because annuity is a small topic. So I just don't have much to say about annuity. I am giving this opportunity for a member of everybody to able to ask a question. Anybody is ready with the question. So back to you, Elizabeth.
Thank you. Thank you so much, George, for that detailed and short presentation. We know it's at night. Everyone has things they want to do before they sleep. But we have some questions in the chat section, which I'd like you to address. Anyone else who has a question, feel free to type it in the chat section. You can also raise your hand. So George, I will just read out to you the first question that we got. Joyce Muya says, we appreciate your continuous trainings. Thank you so much, Joyce. We always aim to keep our customers on top of everything. So before you buy anything, you already know what it is. So you're asking, kindly explain the meaning of lifetime annuity. George.
Thank you, Elizabeth. Thank you, listener. A life annuity, and the reason why annuity is different from income drawdown is because once you purchase annuity, your payment is paid for life. It's just a life annuity, meaning you're paid for life. Annuity has no period like you say 2 months, 3 months, or 1 year. So long as you are still existing and you purchase an annuity, whatever amount you purchase, then you'll be paid till the end of your time. For life, meaning so long as you're still living, you will be drawing the money that you agreed with the underwriters through an ATM or through a bank. So that is just a lifetime payment. Thank you.
Thank you, George. We'll move to the next question. Odundo Emma asks, does the current pension mean my monthly contribution or the total I have in the scheme?
Sorry, Elizabeth, sorry, I didn't get you well. Can you?
I will repeat, George. Does current pension mean my monthly contribution or the total I have in the scheme?
Thank you, Elizabeth, on behalf of the person who has asked the question. The contribution that you are paying currently, you will not earn, you will not give you pension until the age of 50 years, meaning that it is still a contribution. Upon reaching the age of retirement, which is minimum 50 years, you will be entitled for 2/3 pension, 2/3 annuity, and a cash lump sum. So you still have to proceed. If you have not reached the age of retirement, probably you are young. So I'll just continue contributing. You can also do voluntary contribution till the age of retirement. When you reach the age of retirement, that's when you can able to purchase an annuity, or you can purchase income drawdown. Thank you.
Just to add on that, George, for those who do not know what a voluntary contribution is, maybe you can explain that to them.
Thank you very much, Elizabeth. Voluntary contribution is any extra money that you pay, you add on top of what the employer or the employee is paying. Remember, normally the scheme are set in a way that there is an employer contribution and there's an employee contribution. However, many people do not know that you are also entitled, or you're also at liberty to say like, oh, I think my pension is not enough. I feel I should add more. So any amount of money you add extra to what employer and employee is contributing, that is what it's called additional voluntary contribution. So this one is either from other sources or from the same employer. Thank you.
Thank you, George, and thank you all for those who are typing in the questions in the chat section. Let's keep this interactive. And also, if you want us to hear you, if you want to voice out your question, you can raise your hand. I see Frank, you have raised your hand. So I have unmuted you, so you can unmute your microphone and we can be able to hear your question. Frank? Okay, I don't know if Frank can hear me. I will go to the next person who's raised their hand. Stanley, you can unmute yourself. We'll be able to hear you.
Good evening, all of you.
Good
Yeah.
evening, Stanley.
My question is, can one opt to invest with the two service providers for annuities? Or must it be just one? Am I heard?
George?
I didn't get you well. Can you, I don't know, my sound is low.
Let me
Can I
repeat.
get the volume up?
Yeah, what I'm asking is, can one
Okay.
opt to invest with the two service providers for annuity?
Yes, yes. Thank you very much. That is very well put. Yes, you can purchase annuity. You can split your annuity in two portions. Once you reach the age of retirement and you feel like you want to spread the risk, at time is allowed so that you can able to spread the risk, but you're only spreading the 2/3. Remember, the laws only allow you to spread, they use the 2/3. So this 2/3, you can purchase annuity on two underwriters, two service providers, meaning that you can, if let me give you an example, if you have 6 million as your total amount, then you can choose a service provider A because you understand our service provider B. So you can choose both. Reason being, sometimes you feel like you want to spread your risk. For those who think like you doubt, like probably if I spread the risk, I'm safer. So yes, it's allowed. You can able to use two service providers, but based on the 2/3 of your annuity. Thank you.
Thank you, George. Muya,
Thank
you have
you.
also. Thank you, Stanley. I hope your question was answered. Muya, you have raised your hand. Let us hear you.
Thank you. I hope I can be heard. Hello, can
Yes,
you
we
hear me?
can.
Yes, my question is, can you make the AVC, the additional voluntary contribution, in a lump sum? Hello?
Elizabeth, I hope I heard him very well. Can somebody
Yes.
hear me?
Yes, we can
Yes,
hear
we
you,
can.
George.
Thank you very much. The member is asking that can you able to do addition of voluntary contribution lump sum?
Yes.
Normally, in every scheme, there's a trust rule and deed rules. So within the trust deed and rules, you are allowed to add additional voluntary. So the trustee will be able to advise on whether you can able to add some extra money in the scheme or in your contribution and a lump sum. However, sometimes you may not add the money from other sources, maybe from farming or from other business to the same employer's related scheme. However, if you have individual pension scheme, then that one you are allowed to add as much money as possible. Remember, your scheme is guided by the employer, the sponsor. So you cannot outsource any other money and put there as additional voluntary, because some money is either fraud money or scam money. So many times the employer will not allow you to add in the scheme. But if you have additional money that you feel you want to add so that you increase the pension, the best thing is to able to open individual personal pension scheme while you are the sole controller of your own pension. So in that, you can able to add additional voluntary contribution in your own individual personal pension scheme without being monitored or without being controlled. So when you reach the age of retirement, you can do a simple thing. You can able to consolidate all your pension and purchase a big amount of money for annuity or for income drawdown. Thank you.
Thank you, George. I hope, Muya, your question was answered. Just to add on what George said, allow me to plug Octagon into this. We have individual pension accounts. So if any of you are thinking of opening one, you can always talk to us. Keep writing to us on the emails that we had shared or on the invitation, training@octagonafrica.com, and we will be able to help you get a personal pension account. So the next person we want to hear from is Marcella. Marcella, I don't know if you can hear me. You had raised your hand. Okay, if Marcella is not available, Frank, we can hear you. You can unmute yourself.
Okay. Thank you so much for your presentation. Can you hear me?
Yes, we can.
Yes, I can hear you.
Thank you so much, Mr. George, for your presentation. And I have only two questions for you. I used to be a member, a contributor some other times. I was working with another organization, the Catholic Diocese of Kitui. Then I deferred contributing from that pension scheme. Then I applied for a certain percentage, and the other one was held at your with Octagon. Now my question is, how can I join back as a member? Because now I'm working in another different organization. Thank you.
Thank you very much. If I heard you well. You once you get, when you are deferred from an employer, meaning that the employer is still having your fund from the previous scheme. So, and that fund cannot be released to you till the age of retirement. So assume you have not reached the age of retirement, that means you cannot access that money, you cannot use that money. The only option you have is to be able to transfer that money to individual personal pension scheme. So upon transferring the money to individual personal pension scheme, then you can still able to contribute to that pension scheme to maybe at the time till you reach the age of 50. At that age of 50, that's when you can able to access the funds. So ideally, what you encourage or you can tell is that you can visit Octagon so then you can consolidate all your funds together. The one which is deferred or the one that you have from where you're working now, then you can able to put them in your personal scheme. Another option is if you are in a scheme or your employer is having a pension, they have a staff pension, then you can still transfer the same pension from a deferred fund to your current employer now, so that you still proceed on. It's allowed by law that you can still transfer a deferred fund from one pension scheme to another pension scheme. So you are safe to put them either through a pension scheme or through individual personal pension scheme. I hope your question is answered.
Thank you, George. Marcella? Marcella, you can unmute yourself. Okay, before she does that, I'll go back to the chat. Okay, yeah.
I've done it. I'm asking.
Yes, we can hear you.
You can hear me. Thank you so much for this training.
You're welcome.
Yes, I'm just wondering if you took away your 1/3 from your total pension amounts. Can you keep the 2/3 in, not necessarily in annuity or a drawdown? Can it be kept in the scheme to continue earning profit, just in case you don't want to take money away?
Thank you very much. Liz, I hope I heard her.
Yes, George.
When you reach, thank you, madam. Probably it's only that I don't get your name, so I wanted to call you by your name, but it's okay. Thank you very much, madam. When you reach the age of retirement and you have some money that you feel, yes, I don't want to take this 2/3 for annuity at the moment because I still have to structure myself, or I'm planning, or you have other things to do, then yes, you can still leave the money. You leave the money till the day that you feel you're comfortable purchasing an annuity. Remember, the money you leave behind is still the pension money. This is an annuity money. You will not say that, yes, I came and picked the money late, then I will need cash. The terms and conditions still apply because the early age is 50. You can pick the money when you are 65 or maybe you are 70, but you still remain in our custody, and more so it will be adding interest. It will be adding interest because it's in under our custody. But when you are ready, anytime you are ready, you can able to purchase the annuity. Remember, it's not a must that when you reach the age of 60, then you take the money immediately. You can buy time. You can buy time 2 days, 1 month, 1 year, 2 years. Just buy time, plan yourself, then you take that's the day you start the annuity. But remember, at the time you purchase the annuity, it is start from the day you purchase. I hope you get me clear. It will not start at the age of 60. The annuity payment will start at the day that you commit yourself that I am purchasing annuity. If you purchase the annuity when you are 62 or 65 years, meaning that you are going to be paid annuity payment from the age of 65 till the end of your life. But when you leave the money again, the advantage is it will be still having interest. So I hope, madam, you got me clear. I didn't remember your name.
Thank you. How comes members are not aware about this?
Yes, I know many people are not aware of this. When people are told by the employer, it is your time is done, go home. The next thing they run, they come and purchase in annuity immediately the same day. But remember, you can still leave the money for another 1 month, another 3 months, another 1 year. Then you come after 1 year and you purchase annuity. There's no hurry because obviously when you are 60, you've already planned a lot of things. Maybe you already planned yourself. So there's no hurry for money, but there's hurry for planning. In fact, you can have enough time to say, I have like 3 months to plan myself. How much am I going to spend this money? How much annuity am I taking? Who is the best provider? Are they stable enough? Can I do research about them? Who are they? In case I get stuck, who do I consult? I want to do a project. Who is going to assist me in this project? How do I manage the project? But I advise people who are retiring, never should you do a plan when you have money. Plan when the money is still in the bank. Plan when the money is still, you are not taking the money. So that when you are removing the money will go into the project that you already identified. The third that you're talking, normally we take a third immediately. Probably you can take some few months, think about how do I plan, how do I start investing in this money before you pick it. We have cases of many people take the money immediately, then in a month, 3 months time, they have no 2/3. They only rely, the 2/3 is already committed to annuity, a third is already been consumed completely, and this money still need more cash. So I agree with you, madam. These are the information that should be shared that you can still take the money after maybe a period of time and it is not affected.
So do you put it in writing?
Sorry?
I'm asking whether you put that information in writing that you are taking your 1/3 and the 2/3 remaining, you put it in writing that I'll come for it later.
No. Madam, you don't put it in writing. When you are purchasing, when you are given a third lump, remember when you reach the age of retirement, your money is there. The employer only releases you to go home. The employer does not tell you that go home, go and take the money. They only take you to your terms of contract is done. So they do not tell you that your terms of contract is done, and they do not, even the employer, it does not process your annuity. Even the employer does not process your third. You are the person who goes to the pension administrator and tell the pension administrator, I have been terminated, or I've been resigned, or I have retired. Because I've been retired, now I need annuity. Now I need a third. So a third cash lump sum. So even if you don't put it in the writing, the money is still there and it is safe. So you don't have to put anything in writing. The only thing, you don't come and apply for it because you're still planning yourself. When you already plan for yourself, just visit our offices and we process for you your annuity or income drawdown.
Thank you so much.
Thank you so much, George. I will move to the comment section so we can tackle the questions which are there. Wycliffe asks, what example companies in Kenya are the service providers A or B? So he's talking about the table that you had shared on the service providers who offer annuity.
Okay. Thank you very much, my guest. The service providers that are allowed to do annuity are the insurance company. The laws, the RBA, in conjunction with the insurance regulatory body, allows only the insurance company to provide annuity. Annuities are not provided by pension administrators, they are only provided by insurance companies. So all the insurance that are registered by the insurance regulated body are entitled to provide annuity. So, and you guys know only Insurance Kenya. I don't want to mention which insurance is doing what or which insurance is doing what, because when you want, the time that you are ready to purchase annuity, I will do for you a quotation and I will tell you what they are offering and their rates. And because of that, you can be able to make a wise decision. Thank you.
So Emma asks, on average, what is the maximum number of years that the service providers with Octagon have?
Sorry, the number of years, sorry?
The number of years that the service providers with Octagon have.
If I get the question very well, Octagon, we are pension administrators. We are managing pension on behalf of all our schemes. So when member retires, as Octagon, we also ensure that our members go home and retire in a good way. And because of that, we outsource quotes from different underwriters. We don't have a number of years. We just outsource quotes based on the history of the underwriters, based on their stability, based on the claim ratio, the way they pay claims. So because of that, we can able to tell our members, we have given you quotation based on the 4 underwriters, but out of the 4, these are the best that you can recommend. Then a client or our member can able to choose among the best that we choose, but we don't have to identify the number of years. If I got the question right.
You did. So I see Philip Mavuti has also raised his hand. Philip, if you can hear me, you can unmute yourself and ask your question.
Thank you for the presentation and also the exchange which are followed after the questions and answer session. My question is, what are the safeguards of people who are investing in these annuities? Because in the past we have heard of institutions which have collapsed with people's money. Is there any safety which we can say it's tangible, whereby in case it collapses, this is the way forward?
Okay. Thank you very much for that question. Yes. First of all, let me say this. Pension is well protected and pension is very safe. Remember, pension money is protected because remember, there's a fund manager, there's a custodian, and there's also administrator. So for number one, there's no way pension money can get disappeared. Even if when you contribute, the money do not go to administrator, it's go to a custodian. Even the custodian, who are the banks, do not declare your pension as their asset. Your pension contribution is not the assets of the fund managers or the custodians. They don't declare that as the assets. That's number one. In the eventuality that one of the service provider collapse, the RBA has already RBA protect all the pensioners, meaning that when they collapse, there's no way they can able to collapse your money. Your money is always protected. Just report to RBA. You come to Octagon company, which is an administrator. Tell them I was my annuity was being paid by company A, and this company collapsed. What do I do? Then we come just retrieve, because the money, even the money is not kept by them, it's either protected by RBA. So there's no way you can lose your money. I remember 2 months or not last year, we were processing pension for Mumia Sugar. Rest Mumia Sugar has collapsed for many years. Some years ago, we were also processing pension for the Nakumat. NACOMAT collects many years. So meaning that pension money can never disappear, even if an institution collapses, but pension money can never collapse. Thank you.
Thank you for your answer. I'm well answered.
Thank you, Philip. Thank you, George, for that answer. There are two questions here I see which are somewhat related, because John says, please explain the percentages, and Lillian says, you did not explain the difference between 3% or 5% escalation vis-a-vis 0%. This is on the table that you are sharing.
Thank you very much. Can they tell them I've already projected that on the screen? So if they can able to look at the screen, I can able to explain the 0% escalation, 3% escalation, or 5% escalation. So if he or she is looking at the screen, let us look at service provider A. And let's look at example on the first column, that is the second column of zero, no guarantee. So annuity of 0% escalation, you as a member, you are going to be paid 17,976,000. Now, why again will you be paid 15,049 shillings? Because you are having 3% escalation. 3% calculation is you are going to be paid 15,049 shillings per month, simply because the fund manager has factored in an escalation of 3% in eventually that is the market trend. In eventually the market is performing very well, then you also be given a 3% increment. 3% increment. So currently, as you go home, you'll be going home with 15,000 shillings every given month, but subject to 3% increment. So in case there's an increment of 3%, then that 3% will be subjected to your income. Again, on 5% escalation, you can even see the 5% escalation, meaning that you're going to be paid less. So meaning that each and every month you're going to be paid less, 13,000. But in eventuality that the market is performing very well, there'll be an escalation of 5%. You'll be given extra 5% on top of what you're earning. But this is based on the market performance. So ideally, we do not recommend somebody to earn less because of annuity of escalation of 5% or to earn less because of 3% escalation. What we advise our members is just go with 0% escalation, which is 17,976. If you are purchase an unit of 1.6 million, meaning that at this time, your income is not affected. Your income, you've taken the maximum amount of money. You don't mind whether the market is performing low or performing high. Remember that time you are 60, and aging 70, you will not question, why have you not given me my 5%? Or why have you not given me my 3%? You see, so the most important thing is just concentrate on 0% escalation, because they're giving you the maximum returns or maximum payment per month. If you go for 3%, yes, you give you 15,000, which is less by 2,000. However, in eventually the market is performing very well, they is escalated by 3% or 5% respectively. So I hope you understood.
Thank you, George. So we'll go to the next question. Elizabeth Kalungu asks, was looking for options at Octagon where one needs to prepare for retirement early. How to boost savings early to boost the IRR?
Thank you very much for a member. That is a wise member, because ideally, the most important thing is to be able to retire with money. It is not good to retire when you don't have money. As young, those who are young, they can do without money. because they can walk, they are not sick, they are healthy. But people at 60 years plus who are retiring, they need money. One, they need money for their own functionality. So because of that, I do advise member to able to come and boost or increase their pension contribution. And if you're still working and you still have some strength, that you still have some money from extra sources, you open an individual personal pension, so you can able to increase your income when you reach home. So you can ask yourself one question: how much do you want to go home with? That is the income replacement ratio. How much do you want to go home with? So the figure that you want to go home with, we will recalculate for you on the reverse to know how much you can able to calculate on a monthly basis, on a yearly basis. So if you do that assumption and know the exact amount of money that should be in your account at the stage of retirement, then that will be okay to show you this is my income replacement ratio. This is how much I need to go home with. Thank you.
Thank you once again, George. Grace asked, are annuities taxed at point of purchase?
Sorry?
Are annuity taxed at point of purchase?
Yes. Annuity is at the point of purchase. So if you purchase annuity when you are 70, that is the time your annuity starts. When you retire at the age of 50, and that's the time you purchase an annuity. Say I'm 50 years old, I'm retiring either voluntary or through other sources. I've decided to retire, and you purchase an annuity at the age of 50. That is the time your annuity starts. Thank you.
This is going back to what you had explained earlier. Paul is asking, why are the amounts with percentage escalation lower than the 0%?
Yes, I think I've explained that, and maybe to repeat in a minute is that when one purchases an annuity at 0% escalation, meaning that you get your income without subject to an inflation or a promise. So annuity 3% is a promise, meaning that upon market performing well, you'll earn 3%. So meanwhile, because the service provider will give you some more money, they subject you to a lower income, a lower cadre, because eventually the market is performing very well, they'll subject you again on 3% or 5%. That's why it's low. But so those who are earning 0%, they are not subjected to any market performance. Whether market is performing poorly or highly, you are only getting your value of money at 17,976 based on the service provider A in the chart. Thank you.
Thank you, George. Grace says, and if I bought an annuity from life insurance endowment lump sum, will the monthly payments be taxed?
Sorry, once again.
And if I bought an annuity from life insurance endowment lump sum, will the monthly payments be taxed?
If she or he bought annuity with the life insurance, yes. Anytime one person you purchase an annuity with an writer, meaning that your payment, you are going to be paid for life. So it is just affecting your monthly income. I don't know whether I'm responding to the same question.
She wants to know if it's going to be taxed, the payments.
Or taxation or
the monthly payments.
Taxation.
Yes, will the monthly payments be taxed?
Yes, it is taxed. Minimum.
The next question is also on the same, because Kay Mutegi is asking, kindly explain on tax requirements on annuity.
Yes, so tax, one is not taxed. When you reach the age of 65, first of all, you're not being taxed. Another thing, when you are having less than 25,000 shillings per month, less than 25 also being taxed. But when you are above 25,000, then there's a subjection of tax.
Thank you, George. Dr. Peter Otieno asks, if I have 2 wives, who then qualifies for my annuity?
Okay, that's a good question. If you're married to 2 wives, you can do what we call joint annuity purchase. Joint annuity purchase. So meaning that you are legitimately married to 2 wives on a customary law, because customary law allows you to marry more than 2. Then, so long as you can provide the proof for the same, then you are entitled to do you can do joint annuity, so that all of them can earn an annuity. Remember, joint annuity meaning that you are earning and they are also earning. So meaning that you are 2 wives plus you get 3 people earning, and that's spreading your annuities. Everybody's earning. That's it. That's called joint annuity, meaning that you have 2 wives. Let me explain again. You have an annuity that you purchase, and you want to be the part of that annuity, meaning that if you are to earn maybe 15K, then that 15K is spread to the 3 of you. So each member is going to earn 5,000 each, so long as you included them in what we call joint annuity purchase. Thank you.
Thank you, George. Lillian asks, what do you mean by age of retirement? If I purchase annuity at 60, is there a monthly tax on annuity considering the 2021 senior tax passed by budget / parliament?
Thank you. There's an act in the parliament that I think it is barring anybody from being taxed, for anybody from evading tax. Initially, there was an age bracket of 65. When you reach the age of 65, then you are not entitled for a taxation for pension after 65. However, the government has put a bill that anybody is entitled to tax whether you are old or not. But I think that is still disputed. I think the matter is still pending. Some lobbies went to court, so that matter is still pending. So once the court made a ruling, so probably can able to know the position.
Thank you, George. Stanley, you're asking if we can share the slides with you. As I had mentioned earlier, we usually record this session and upload it to our YouTube channel. So since you registered for this, we have your email addresses. We will share a link to the training, and you can go back on this whole session to see what you need to go back to. We have another question from Dr. Peter Otieno. He says, can I use the 50% held by my former employer and use it to purchase annuity or any other business?
Thank you, Dr. The 50% that is held by your employer, if you move to another employer B, probably that's an employer A, and you still have the 50% that is pending there, and you did not pick that 50%. Remember, you left it there and you didn't pick it, and you are attaining the age of 50 years or every 60 years, and you feel like, okay, I was having some 50% in another employer. So yes, you can go there and purchase annuity, because the law still, you can still take that money and purchase annuity.
Thank you, George. Nancy, you say thank you for this session. You're welcome. You have said that annuity is taxed at point of purchase. Kindly explain what percentage.
Thank you very much. There is a tax bracket for each annuity purchase. So probably allow me to work on the tax bracket so that once you're sharing this slide, I can able to give you an Excel or a calculation or computation on a tax bracket for each and every annuity purchase, so you can know how much you go home with if you purchase a specific amount of annuity. Thank you.
Thank you, George. Stanley has asked a really interesting question here. He's saying, If I retire, say at 50 years, and start getting annuities, then say I get re-employed at 57 years, say by a county government, do the annuities discontinue now that I am employed again?
No. Thank you very much. I've just studied that no, but thank you very much. That's an interesting question, and it's a question that we can able to handle. Yes, no. Once you get your annuity and you're being paid annuity on a monthly basis, even if you go get a job in another government body or you get re-employed again, that your annuity still proceeds. It will not say that you guys are enjoying annuity, so you cannot get a job somewhere again. No, your annuity still proceed. Remember, where you go and work, they also have another setup of maybe another scheme. You can still join another pension scheme, or you can also join a contract. But the pension from the other employer you used to work with till the age of 50, and you purchased annuity at the age of 50, that pension will go for life. If you move to another employer and also start working there, and also work for another 10 years and raise some money, and the employer was on pension, then you can still purchase another annuity and have two annuity from two different schemes. So yes, it's possible. The annuity that you proceed from the other employer will not cease, it will still proceed. Back to you, Lizzie.
Thank you, George. I want to unmute Marcella. I see you have raised your hand. Marcella, you can unmute yourself.
Yes, Liz.
Yes, Marcella, we can hear you.
Yes, what I wanted just to confirm something from our discussion with the George, that I can take my 1/3 and I leave the other 2/3 in the scheme for a period that I will determine. Now, during that period, I relocate and I go abroad and I become a citizen of another country. Do I come back for these 2/3 and I pick it lump sum?
Thank you, Madam. It's once again I didn't get your name. To clarify this, when you leave Kenya to another country before the age of 50, I said you can take all your money. If maybe you get a citizenship to another country, so long as there's a proof of citizenship to another country, you can take all your money. If you reach the age of 50 and you already purchased an annuity, and the annuity is you still being getting a monthly payment, an annuity, even if you go abroad and get a citizenship, your annuity will still be paid to your account. Remember, because you are abroad and your money is still coming, even if you get a citizenship, that one will not stop you from getting your annuity, because that is a contract that you've done for life that you still have to enjoy. Madam, allow me to tell you that most of the people who come to Kenya for tourism in Kenya, in Mombasa, the whole people from UK and developed countries, most of them are retirees. And whatever they're consuming in Africa is from their retirement pension or annuity. So that annuity, whether they stay in Kenya for life or decide to live in Kenya for life or change their location to Kenya, they still have to earn that annuity. So even if you move abroad and you've been earning annuity in Kenya, that annuity, they will not stop paying you because you relocated.
No, the question I had.
Answer it clearly.
Question I had is we agreed that you can leave 2/3 in the scheme to continue earning interest because you have not signed any agreement to use purchase annuity. You have not used the amount to purchase annuity. You have just decided to leave the money in the scheme so that you collect it later. But I'm saying, suppose in between here you transfer, you go abroad and you are a citizen. Can you now come back and collect your 2/3 lump sum which you left in the scheme?
That's a good question. If you left 2/3, before purchase, then you get a citizenship of moving out of the country.
Yes.
One of the conditions that the government state is that that 2/3 that you left, because remember, you already attained the age of retirement. That's number one.
Yes.
Either you attain the age of 50 or you're 60, you attain the age of retirement. So meaning that that 2/3 that you left, it will still subject to an annuity, because the essence of this is the government want that anybody is going home should have income coming to your account every month, every given month to sustain you. If you move out of the country and the lump sum is there for 5 years, over 10 years, the day that you come back, they will not give you the cash lump sum. They will say it was a 2/3 rule. That means they will still say this money which is in the account, it was a lump sum which may be 4 million or 10 million, you purchase annuity. So at that time, maybe you came back, maybe you're 70 years old or 80, you will still subject you to annuity because terms and conditions apply. You will not get the cash lump sum.
Okay.
Yeah.
Thank you, George. Grace, you have also raised your hand. We would love to hear you. You can unmute yourself.
Thank you very much. I'm sorry, I'm going to take you back to a question that was answered on taxes. We've seen a lot of insurance life agents selling the endowment plans to clients because the lump sums are tax-free. So my question goes back to, George just confirmed that at the point of purchasing the annuity, there's a tax rate. So will still the proceeds from the life insurance lump sums will they still be subjected to tax since they were tax exempt?
Okay, thank you very much. The guest was asked question. That's a good question. When you are remember when you are purchasing annuity or on retirement, let me just take you a bit on contribution. Whenever you're doing a contribution to a scheme, there's an option of tax exempt and non-tax exempt. Good. Now, when you are retiring, then the actuarial will be able to calculate which money was tax exempt, which one was not tax exempt. When you are purchasing an annuity, also it will also come like how in this annuity you're purchasing, how much was tax exempt, how much was not non-tax exempt. So when you are going home with annuity purchase, then it will be subjected to tax, yes, but we will look at how much money was taxed so that you don't get double taxation. How much money was taxed and how much was not taxed. So because of that, we can able to check how much you're going home with so that we tax where applicable, but not doing a double taxation. I hope it's clear. So whenever we are purchasing, we will give you a statement and we'll let you know that this is your annuity and it is this much because this fraction, this amount of money was already taxed as initially. So we cannot do double taxation. This is how much you go home with. So normally it is being taxed, but minimum because some of the money has been taxed when you are initially.
Thank you, George.
Elizabeth?
Yeah, thank you for that. I've noticed that there's some questions I missed on the comment section. Terry says, what is the advantage of superannuation scheme?
Super what?
Superannuation scheme. I don't know if Terry, you can raise your hand so we can unmute you and you can explain to us what you mean, Terry, if you're still with us. Also, there's another question by Paul. He says, is lump sum allowable? Is 1/3 or can it be more? I think that's what you're trying to say. He's asking if the lump sum allowable can be 1/3. Is it just 1/3 or it can be more?
The maximum is 2/3. The cash lump sum is 1/3.
Terry, we would love to hear you out. I don't know if George, you got what she meant by that.
No, I didn't get that. I wanted to get it from her.
Yeah, Terry, if you're still here, you can raise your hand. We have 5 more minutes left in this meeting. And as we wind up, I'd love to thank each and every one of you for making your time and joining us today. Our vision is always to safeguard lifelong learning for our clients, so that we can continue to guarantee you financial security. We hope that you feel that your financial security is a bit more guaranteed. Emma, I saw your concern. For those who have not been getting the links to this training, you can subscribe to our page on YouTube at Octagon Africa, and you can click the notification button. So every time we post a new pension clinic, you get that notification and you do not miss anything. I see someone else has asked a question. John says, what does the new bill say about the lump sum? George?
I've already mentioned about the cash lump sum. The cash lump sum, I said you take the cash lump sum, which is 2/3. I mean a third. Then cash, the annuity is 2/3 or income drawdown. That is the law.
Because I see also K Mutegi is also adding to his question. So cash lump sum is a third, and 2/3 must go into annuity. Is it a must for it to go into annuity?
It's not a must. It's not a must. There are only 2 options available. One of the option is the income drawdown, and the second option is annuity or annuity income drawdown for 2/3. And there's also something we didn't mention, which is also the mortgage. So that next time we'll talk about the Mortgage Act, how much one can able to access a mortgage on the retirement. So we can talk about next time we have a meeting like this. Thank you.
That will be amazing, George. Kemutegi, you want to know about income drawdown? I think we will also plan a whole session like this one, as we have done on annuity, and talk about income drawdown and the options that you have in that, because I see that we are running out of time. But in case of any question you might have, I see we still have more questions about the mortgage. Please write to us at training@octagonafrica.com. We will be sure to respond to you. If you need an individual pension plan, as George has talked about before, still write to us on that email, and you're also welcome to visit us at our offices. We are located at Ojijo Road, West Park Suites, 8th floor. Our office is Octagon Africa. The door is always open, and we always want to hear you out and engage with you. Thank you so much for the comments. Thank you so much for the questions that you have done. It has truly been a very interactive and engaging session. Again, I will upload this training tomorrow on YouTube, and I will share the link with you. Emma, I will make sure that I do send it to you. George, any last remarks?
Thank you very much, ladies and gentlemen. This was a wonderful session. We had several questions. For those questions that didn't ask, kindly liaise with the list, and through our email, you can able to respond through, or you can reach us through our line or through our email. So it was a wonderful interaction. I thank you all. May God bless you.
Thank you, George, for that wonderful presentation. I've typed in down our number where you can always reach us through, and the email is also on the comment section. Bye-bye. Thank you. See you again. We usually do these trainings after every week. So the next training is probably going to be on the 2nd week of July. We hope to see you there. Thank you so much, and good night. You can leave at your own pleasure.